Everyone, and welcome to the Caxton FX and Ukie Access to Finance webinar. I'm Joe Wass, Head of FX Strategy at Caxton, and alongside me today is Michael Brown, Caxton's Senior Market Analyst. Throughout this webinar, we aim to outline a number of things, including the recent global pandemic, that is COVID-19, along with ways that a number of businesses are currently looking to reduce their foreign exchange risk. Our contact details are available at the end, so should you have any questions, please don't hesitate to get in touch. As a proud Ukie member, we are also offering a hotline service where we aim to answer any queries you have on the current economic climate and where we may be able to help. With that, I'll pass you through to Michael to introduce himself and start the webinar.
Thank you very much, Joe. Good morning, everybody. As Joe said, my name is Michael Brown, the Senior Market Analyst here at Caxton. And what I wanted to do today was have a look at the one theme that really is dominating not just investors' minds, but really everybody in the world's minds at the moment. And that is the coronavirus pandemic that seems to be moving very swiftly westwards across the world. It obviously began in China and then moved to Europe, particularly hitting Italy and Spain incredibly hard, and now appears to be moving over to the US, where New York City has now become the global epicenter of the pandemic. Of course, there are a lot of unknowns around the coronavirus, and unfortunately, the unprecedented nature of the situation that the world currently finds itself in means that there really are more questions than answers when it comes to the things that investors want to know the most. How many cases will there be? How long are these shutdowns going to last? How are the markets going to react? How or even will the global economy be able to recover from the sort of hibernation that policymakers have tried to put it into? And unfortunately, these questions, the answers to these questions will only become clear as the weeks and months progress and as the pandemic hits its peak and then begins to fade away. But one thing that the pandemic is definitely doing, and one thing that the unknowns surrounding the virus are definitely doing, is increasing volatility across asset classes. You can see on the chart here, you've got volatility for the S&P 500, which is the benchmark US equity index, incredibly elevated. Gold, incredibly elevated. Euro dollar, one of the major foreign exchange pairings, also incredibly elevated. These charts here are indexed to 100 at the start of the year, and you can see almost you could plot on here a timeline of the coronavirus pandemic, how it was declared a pandemic at the beginning of March, how it then began to sweep across Europe, and how it then began to hit the US, and we saw a very, very violent sell-off in the equity market and a rotation into safer havens as a result of the virus and the unknowns that it will cause. Why is volatility so high? Well, very simply, investors want cash. Investors don't want to be in the market at the moment because they don't know what is going to happen. Because of the uncertainties, because of the unknowns surrounding the virus, nobody wants to leave risk on the table and instead are taking their money off the table and putting it either into the bond market or into cash. And particularly when we talk about cash, people are putting their money into the US dollar. As a result of that, cable, sterling against the dollar, has absolutely tumbled over the last couple of weeks. We were plodding along very nicely for most of the year around the 130 mark, and then towards the beginning of March, we took a bit of a steep tumble, down almost 12% to a 35-year low, just above the 114 level. Now, actually, while sterling was incredibly volatile over the last 3 or 4 years due to what's been going on with Brexit, this had really nothing to do with the pound. Although sterling is a bit of a riskier currency than it was previously and probably did face a few headwinds as a result of that, the majority of the move that we saw in sterling dollar all the way down below the 120 mark was because of this insatiable demand for the dollar. Almost every investor everywhere wanted to hold dollars as a result of the pandemic. It is the global reserve currency. It is seen as a safe haven. And as a result of that, there really was no substitute. Everyone was flooding into the dollar. And that is why you saw sterling dollar push so much lower. In terms of where this goes next, actually, I think sterling has found a bit of a bottom here at the 114 level. It has begun to recover. The market has continued to press higher. The reason for that is twofold. Firstly, investors are looking for glimmers of hope when it comes to the virus in terms of is there a vaccine on the horizon? have the infection curves begun to flatten off? Are cases beginning to stabilize? Is the situation getting ever so slightly better? Is there a bit of light at the end of the tunnel? But also you have seen aggressive policy easing from global central banks, as the next slide shows. This is the average interest rate that central banks have set: the Bank of England, the Bank of Canada, Bank of Japan, European Central Bank, the Fed in the US, the Reserve Bank of Australia, the Reserve Bank of New Zealand, all the way back to 2007, so just before the financial crisis hit. And obviously you can see that during the financial crisis, the average policy rate was cut very, very aggressively to try and stave off the worst of those, the worst of the effects of the financial crisis. We then had almost a decade where rates remained at an incredibly low level. Barring the Federal Reserve in the US and a couple of isolated examples elsewhere, central banks have actually struggled to hike interest rates even in the 10 years after the financial crisis. The market has become somewhat hooked on this easy money that central banks have continued to provide. And then what you've seen at the start of 2020 is, again, interest rates have fallen off a cliff. Central banks have aggressively cut rates, aggressively put in additional liquidity measures to try and ensure that the market continues to function. And what that means is that the central banks and the policymakers are trying to avoid what is the biggest public health crisis in a generation, an absolutely unprecedented event. They are trying to avoid that spiraling in to an out of control financial crisis that would be much worse than we saw in 2008. So the effect of cutting interest rates, that has soothed some nerve. The stimulus has come in and boosted sentiment a little bit. So you have seen those volatility levels on the second slide begin to pull back a little bit, but nonetheless, markets are by no means out of the woods just yet. The news surrounding the coronavirus is likely to get worse, and actually sentiment will probably deteriorate with that before things begin to get better. Next, we would usually use the word forecast or estimate, but in this case I would prefer to use the word guesstimate, because really no one knows exactly what is going to happen with the coronavirus. No one knows how long the lockdown measures will go on for. No one knows how quickly the economy will recover in terms of the global economy. And no one knows exactly when we will be able to return to some sort of normality. But there are three scenarios that I'd like to lay out in terms of how the global economy could recover. Now, the best case scenario, although it would still be a pretty grim scenario and would involve a recession, is a V-shaped recovery. Now, this is where you have a very sharp, very sudden fall in output that's followed by a recovery that is equally as sharp and equally as quick. When the coronavirus epidemic first began in China, we were thinking that a V-shaped recovery could occur. We would have a situation that was isolated to China. It wouldn't inflict too much damage on the rest of the world, and everyone could recover very, very quickly indeed. However, as the virus continued to spread and as this became much more of a global issue, and as the lockdown measures came in, as I said, sweeping across the Western world, the V-shaped scenario, the V-shaped recovery really did have to fall by the wayside, because it is now clear that the lockdown measures that have been imposed are going to have a more longer lasting, more prolonged effect on the global economy. As a result, I think my base case is now for a U-shaped recovery, where you have a slower, a bit more of a gradual fall in economic output, an obvious bottom, which will hopefully and likely come at some point in the second quarter, before a gradual recovery in the second half of the year, before the global economy can begin 2021 on much better footing than where we stand now. The worst case scenario, and a scenario that at the moment is unlikely but could become much more likely if the lockdowns persist into the second half of the year, is an L-shaped recovery. Now, I use the word recovery. I shouldn't use the word recovery, but because an L-shaped scenario involves a very steep, very sudden fall in output as a result of the global economy effectively being turned off like a light switch overnight by governments, and then a prolonged, lengthy period of stagnation, where the impotence of monetary and fiscal policy is exposed, cannot stimulate the economy, and we end up stuck in a little bit of a rut for the remainder of the year. That may come about due to the impotence of policymakers, or It may come about due to perhaps a second wave of the virus later in the year, meaning lockdown measures need to come back in. Perhaps the virus continues for longer than we expect, meaning that lockdown measures can't be lifted at the end of the first half of the year as we're expecting at the moment. So although the base case at the moment is a U-shaped recovery, the V shape is off the table, and L shape is by no means out of the question, and the global economy is by no means out of the woods just yet. I said the word guesstimate on the last slide. I'm going to say the word guesstimate again. Here are some forecasts, some expectations from a number of investment banks, a number of tier 1 banks on where they think sterling dollar will be in the next 12 months. Now, if you'd asked me to do this presentation this time last year, it would have been full of me talking about Brexit and how the direction of the pound depends on whether we get a Brexit deal or not. I think Brexit can now fade into the background a little bit. The outlook for sterling dollar depends on two things. Firstly, it depends on what the demand for the dollar looks like as we go through the remainder of the year. And secondly, it depends on the global risk environment. If we see sentiment sour once again, if the virus becomes a little bit more severe, then sterling will likely head lower. But as you can see, roughly the tier 1 banks expect sterling dollar to hover around the 127, 128 mark on average, with a few outliers by this time next year. The picture is very similar for sterling euro. Again, quite a range of forecasts, but on average, you're looking at around the 114 level in terms of an average forecast for the end of the year from the major investment banks. Again, this will depend on the global risk environment, and it will also depend on how the UK and the Eurozone economies recover, and particularly whether there is any divergence in the two. If the UK economy begins to recover more quickly than you've seen in the Eurozone, if the Eurozone economy takes a much harder hit from the coronavirus than we do in the UK, then you would likely see sterling euro press higher as the euro sells off. If, for whatever reason, the UK economy doesn't recover quite as quickly as the Eurozone, then sterling euro will obviously head lower. But as I said, the median projection is around the 113, 114 mark. So with that in mind, I'll now hand back to Joe. I hope that's been informative for you. I'll hand back to Joe and he will be able to explain how this will affect your business and how we can help work with you to protect your business in these volatile times. Joe?
Thank you, Michael, for that brilliant overview of the current global economy. We've seen quite a drastic increase in what do we do questions lately. And while we don't have a crystal ball to predict the future, we can hopefully provide a helping hand in a number of different areas. So kind of as an overview, businesses that do export their products and services without having to purchase those raw materials from abroad can right now probably capitalize on the weaker pound as their exports could appear a lot cheaper. On the flip side, those that are importing from abroad will no doubt feel the pinch, especially when sterling euro is trading at 107 and sterling US dollar trading down there in the mid 114. So those importers will really feel the effects of a weaker pound, as it won't stretch as far as definitely what it used to. One thing that we do come across quite a lot is questions as to how currency really can be managed in a better way, and one key article here that we tend to use quite a lot in any reference studies is Rent-A-Kill. So after the UK referendum, they're obviously one of the big gainers from the plunging pound because its revenues are made outside of the UK. With currency rates falling to where they fell post-referendum, they'll make an extra £15 million this year, back in 2016. Those kind of currency swings previously were, how can I word this properly? You'd never see them, whereas now a 2%, 3% daily swing is normal. Times like these are unprecedented, but there is opportunity in there to take advantage of low rates, especially if you are an exporter. And we can hopefully give you a few, not necessarily ideas, but a helping hand as to where we may be able to assist you. Obviously, if sterling does continue to remain as volatile as it has been throughout March, not only 2020, but for the rest of this year, we do expect businesses to really have difficulty in forecasting a lot of requirements and also kind of looking to protect their budget levels. We do at Caxton work with a number of Ukie members. We also have a number of clients in the gaming industry as a whole. So where we do find that revenue streams are international, it may now be a worthwhile time to really look to review that hedging strategy and essentially see what's available to you to potentially secure any extra income. When it comes to actually building a hedging strategy, the first question you need to ask is, what are you looking to achieve? Are you looking to protect against all of your currency flows? Are you looking to really manage that at 100%, or are you looking to only kind of cover a proportion of that? So the first thing is really defining that company objective. What are you looking to achieve? Once you've done that, deciding a hedging ratio appropriate for your business risk. So this can typically range from 50% to 75%, all the way up to 100% of your forecasted exposures. This can also be layered over time, meaning that you hedge 100% of your short-term exposures, say for example 3 months, 75% of your medium-term exposures, 4 to 6 months, and maybe 50% of your longer-term exposures, all the way up to maybe a year out. As each quarter passes, you top up each quarter and add an additional quarter at the back end. If anyone has any questions on how that may work, like I said, our contact details are at the end. Please feel free to ping me a question over and I'll be more than happy to assist. Thirdly, analyze the suitable FX products available. So you should always do due diligence on the type of products that could help your business. Some may be suitable, some maybe not be suitable. It can range really from spot transactions, which in this current economic climate may not be the best course of action, all the way through to forward contracts, which enable you to lock in a level of protection, through to FX options and structured products, which are regulated products that Caxton are fully authorised and regulated by the FCA to offer. And essentially, in a nutshell, without going into too much detail, they are similar to a forward contract, however, kind of give you the ability to transact in upside as well. And finally, constantly review its performance. Again, if you're a client, you may wish to do this yourself. However, one of the services that we do is provide you with that level of review and performance, just to make sure that your clients do have the best solution in place for their requirements. As you'll see on this slide, here we have a little overview of how forwards work versus participating forward. A standard forward contract essentially means that you lock in a set rate for a set period of time. For example, if you have a budget rate to sell US dollars at 130, if the market falls to 125, you can lock in that rate for a set period of time and pay away as and when you need to, knowing that you've secured a rate of 125 to the pound. This is a lot better than your budget rate, and also protects you from if the market was to shoot all the way back up to 135, and essentially you are either having to increase cost to your clients because you're not hitting your budget rate. The advantage of that, there's no upfront cost for a forward contract. You get absolute certainty of the rate you've achieved, and like I mentioned a second ago, you're able to settle flexibly, meaning that you can pay away as and when you need funds. Disadvantages, there is an obligation to convert at a fixed rate. So like I said, if you are selling US dollars on a regular basis, if the market fell to 120, unfortunately you have locked in at 125, meaning that rate is a little bit more adverse to what you'd have achieved at the spot. But if the rate goes the other way, then you are essentially quids in. There's also no possibility to achieve an enhanced rate. What I mean by an enhanced rate is something that I'll go into now with a participating forward. This is essentially a product that gives you a similar, you'll always have 100% protection for a worst case rate. It will be a little bit adverse to a forward contract. So where a forward contract rate may come in at 125, a participating forward rate may come in at 123. However, if the market transacts higher when you do need to settle the funds, say for example 115, you'll get 50% at your protected rate and 50% at the underlying spot rate at the time you need to, at the time the transaction expires, meaning that your average rate, say for example the market was at 117, you'd receive an average of 120 for that settlement. You do retain the right, but not the obligation, to obviously participate in favourable exchange movements. The upside is essentially unlimited, meaning yes, you have to do a set percentage at your protection rate. However, if the market went to parity, you would be able to achieve upside on that level. There is also no premium payable for this product. The disadvantages, obviously the protection rate will be less favourable than the forward contract, and you will be obliged to deal a portion of your requirement at the protection rate. For those kind of products, we advise that you speak to our head of FX risk management and derivatives, who is Rahan Ansari, and I'm more than happy to put you in touch with him should you deem this is something you want to explore in a little bit more detail. Rahan is fully CF30 and has, like I mentioned earlier, Caxton has the right to offer these products given our FCA regulation and authorization. In terms of hedging approaches, now this may seem complex to the eye, but it really isn't as complex as it may look. We are finding now that a lot of businesses are looking to adapt their hedging strategies, and that has changed a lot over the last few years. As currency markets become a lot more volatile, people don't really want to necessarily stick into a set and forget forward contract where they have a set rate, but that's it. There's nothing else to it. So people are looking at more multi-product strategies as opposed to the more static hedging strategy. Not saying that one is better than the other, as I mentioned a few slides ago. You should be able to decide that with guidance from maybe someone like Caxton, but also once you've decided your business risk and the level of cover you want, this is where these kind of products may become a little bit more beneficial. With volatility a lot higher right now, especially in sterling currency, cross currencies, and also if you are seeing a little bit more uncertainty with your exposure, you'll see that a multi-product hedging strategy may be best suited. That means that you can blend in spot, forward, FX options to create essentially a balance of products that enable you to get the right level of upside, but also guarantee you the right level of protection as well. Like I said, both the business appetite to risk and the volatility within the FX market identifies really the two most common strategies our customers are executing today based on these really increased levels of volatility in the market. Now, like I said, this is something that we can help you with and maybe provide you with new ideas that you may not have seen before through a banking counterparty or an additional third-party broker like Caxton. But in these times, if you are seeing uncertainty, maybe adapting or looking at something new may be the best course of action. With that, please get in touch. We hope that this webinar has given you a good overview of the current economic climate. Like we've both alluded to, there is no crystal ball to see what the future holds. We can only really take this day by day, week by week, but we are a Ukie member, and with the hotline access as well, we're more than happy to answer any questions that you may have. Both my direct line and my email are listed below, same for Michael as well. But other than that, we hope you're all staying safe and look forward to hearing from you soon.